What if I told you that every time you swipe your credit card, someone is making money, even if you pay your bill on time? Most people think banks only make money when customers miss payments and get charged interest. That's true. But it's only part of the story. The reality is that the credit card industry generates hundreds of billions of dollars every year through a business model that most people never notice. And once you understand how it works, you'll probably look at your wallet a little differently. Let's start with a simple question. Imagine you walk into a coffee shop and buy a $5 coffee using your credit card. You tap your card. The payment goes through instantly. You grab your coffee and leave. Seems simple, right? Behind the scenes, however, something much more complicated just happened. Your bank paid the coffee shop on your behalf. The coffee shop didn't actually receive the full $5. Instead, it paid a small transaction fee, usually somewhere between 1% and 3%. That might not sound like much, but now imagine that same fee being collected millions of times every single day. Coffee, groceries, gas, restaurants, online shopping. Every swipe creates another tiny payment flowing through the financial system. Individually, these fees are almost invisible. Together, they become billions of dollars in revenue every year, but transaction fees are only the beginning. Now let's talk about interest. This is where banks make even more money. Imagine two people. Sarah pays her credit card balance in full every month. She never pays a penny in interest. Jake, on the other hand, spends $3,000 but only makes the minimum payment every month. At first, it doesn't seem like a big deal. Maybe his minimum payment is only $60. It feels affordable. In fact, that's exactly how many people get trapped. When you only pay the minimum, most of your payment doesn't reduce the amount you borrowed very quickly. Instead, a significant portion goes toward interest. That means your debt can stay around for months or even years. Let's look at an example. Suppose you owe $3,000 on a card charging 24% annual interest. If you only make minimum payments, you could end up paying hundreds or even thousands of dollars in interest before the debt finally disappears. The original purchase may be long forgotten, but you're still paying for it. That's why banks encourage minimum payments. They're legal, they're convenient, and for many customers, they keep the debt going much longer than expected. Here's something even more surprising. Many people don't realize how expensive credit card interest really is. If someone offered you an investment that guaranteed 24% every single year, you'd probably think it sounded incredible. Yet millions of Americans pay that same rate in reverse. Instead of earning 24%, they're paying it. And that small difference changes everything. Of course, not everyone who uses a credit card ends up paying interest. Many people use credit cards responsibly. They earn cash back, collect travel rewards, build their credit score, and pay the balance in full every month. For those users, credit cards can actually be useful financial tools. So if some customers never pay interest, why do banks still offer generous rewards? That's where things get really interesting. Because the rewards you're earning aren't always coming from the bank's generosity. In many cases, someone else is helping pay for them. And once you understand who, you'll never see reward points the same way again. So, who actually pays for all those cashback rewards and free airline miles? The answer might surprise you. Every time you use your credit card at a store, the business pays what's called a processing fee. Most stores don't absorb that cost themselves. Instead, they build it into the price of their products. Think about that for a second. Imagine a grocery store sells a gallon of milk for $4. If the store has to pay credit card processing fees on thousands of transactions every day, those costs eventually get passed on to customers through higher prices. In other words, everyone helps pay, even people who use cash. So when you earn 2% cash back, that money isn't appearing out of thin air. It's part of a much bigger system where transaction fees are built into the prices we all pay. Now, here's something even more interesting. Studies have found that people often spend more when using a credit card than when paying with cash. Why? Because handing over cash feels different. When you pay with physical money, you actually see it leaving your wallet. Your brain registers the loss. But with a credit card, it's just a quick tap. The purchase feels almost effortless. That tiny difference changes human behavior. Restaurants know it, retail stores know it, online shopping websites definitely know it. That's one reason why checkout pages make paying as easy as possible. One click, one tap, purchase complete. The easier it is to spend, the more people tend to spend. Now imagine this happening every day. Coffee in the morning, lunch at work, a few online orders, a streaming subscription, maybe a late night impulse purchase because it was on sale. Individually, none of these purchases seem huge, but together, they can quietly grow into a balance that's much harder to pay off than expected. That's exactly what banks are counting on. Not because they want customers to fail, but because carrying a balance is extremely profitable. Now, before you throw away your credit cards, here's the important part. Credit cards are not the enemy. Used correctly, they're one of the most powerful financial tools available. They can help you build a strong credit history. They offer fraud protection. They can provide travel insurance, purchase protection, cashback, and rewards. The problem isn't the card. The problem is using borrowed money without a plan to pay it back. Here's a simple rule that many financially successful people follow. Never treat your credit limit like extra income. If you can't afford to buy something with the money already in your bank account, think twice before putting it on a credit card. Another smart habit is to pay your full balance every single month. Not the minimum payment, the full balance. That way, you avoid interest completely while still enjoying the benefits of the card. And if you already have credit card debt, don't panic. Many people do. The first step is simply understanding how interest works. Then focus on paying off the highest interest debt first, while continuing to make at least the minimum payments on your other cards. Small, consistent progress adds up over time. Here's the biggest takeaway from this entire video. Banks aren't making billions because credit cards are magical. They're making billions because millions of tiny decisions happen every single day. One extra purchase, one minimum payment, one missed due date, one impulse buy. By themselves, they don't seem important. But over months and years, those small decisions can completely change someone's financial future. The good news? The same principle works in your favor. One smart decision today can become hundreds of smart decisions over the next few years. Pay your balance in full. Avoid unnecessary debt. Spend intentionally. And let your money work for you, instead of working for someone else. So here's my question for you. Do you pay your credit card in full every month? Or have you ever been stuck making only the minimum payment? Let me know in the comments. If you enjoyed this video and want more simple explanations about money, investing, and personal finance, subscribe for more, because understanding how money works is one of the most valuable investments you'll ever make.